Hey, Collier family, Brandon and Will here. We thought with the events of the week in the market, we thought it was important to come to you with a good constructive conversation as to transition possibly from market correction to we went down and touched uh, close to a bear market this week. So we wanted to give you some information. Does that mean anything different for you? As you can see, young William here is not in office. COVID did catch up with him and his family this week, but he's gutting it out because we feel like it's important to address some of the events of the week. Will, how you feeling?
I'm doing better. It was a rough couple of days, but I outran the plague for 3 years, so it's pretty reasonable considering the experience. The kiddos and the wife were probably a little more frustrated that they were stuck with me for a week inside the house, so that was probably the worst part of it for
I think my family would echo the same sentiment. So, what changed this week? So the markets went from a normal correction, which we've sent you communication before, was on average about 14% down on the S&P 500. That's how we judge the overall United States stock market. We said in midterm election years, the average is actually a little deeper, about 17% down. And we crossed that this week and we went and touched almost 20% down. And at 20% down, it goes from a correction to a bear market. So we wanted to add some information for you to understand what does that mean? Does that change anything for you individually? So that's what we'll do today. So first part, what's the difference between a correction and a bear market? Well, we just explained from an overall percentage drawdown what that means. What I'd like to bring up is a chart we sent you this week. This chart is from JP Morgan, and it shows the inter-year drawdown on every year going back to, let's see here, 1980. So about 42 years worth of data here. And when we sent that to you this week, it was with a letter about my daughter getting back on the bike. And I know we've sent you a lot of evergreen information. We all know at this point that, hey, we got to stay the course, and that if we do over the long term, generally things work out. You may be sick of that message at this point. That's why we wanted to give you something a little more concrete, data heavy today. So on this chart, you'll see we've had multiple times where the markets have gotten close to or actually stopped at that 20% down number. We've had a number of those actually fairly recently. The most recent one was 2018. We had the market went right down. Actually, Christmas Eve was the bottom, got to 19.8, somewhere in that range, didn't cross that 20 number, and actually recovered from there. We've had other periods of time. 2015 and 16 doesn't really make the chart because it split the year. It happened at the end of 15 and beginning of 16. Same thing, close to 20, bounced. And then we had it also in 2011. And so you'll see years like that where for one reason or another, the market will get to that 20% threshold and just doesn't break through. What we've seen historically is when it does break through, generally it's in combination with a recession. And you'll see that the years that it goes deeper than that 20% drop inter year, it goes down to, on average, about the 34% range. And obviously 2008 was much deeper. Those years coincided with recessions. So that's 2008, that's 2001 and 2. And so you saw those were much deeper drawdowns. So the question becomes, are we going into a recession? So we figured now that we've added a little bit of context that getting to this 20% down number can mean a bear market. Does that change anything? The answer is, well, yes, if it's in combination with a recession. So let's unpack. Do we currently see numbers that are pointing towards a recession?
Well, and one thing I'll kind of add in there, Brandon, is I think that it's important for people to understand that those levels, a 20% downturn and turn into a bear market, their significance is not necessarily strictly from an economic standpoint. The reality is that the entire economy, the stock market, it all fluctuates based off human behavior. And so when we see a 20% correction and the news starts covering bear market, a lot of times that's a psychological indicator for people to be like, oh no, I've got to start getting and get selling because this is bad. The same thing when they hear the word recession. Before they heard the recession, the economy was kind of operating. It was like things are tough, business is a little bit tougher. When we start hearing the word recession, people start thinking, well, I need to conserve capital, I need to spend less. Businesses start thinking, well, we're in a recession now. And so I think it has a pretty strong psychological indicator, and that can dictate some behavior. I think that's one of the reasons that we're talking today is to recognize that there's a behavioral element to the markets. And when you hear some of these sort of definitive elements, it's not uncommon to want to have a reaction to that.
Yeah, almost manifest destiny.
A little bit, yeah.
We start fearing a recession so much that we cut back on our spending and basically pull ourselves into a recession out of the fear of going into a recession. That's a very real thing that has happened. And, that's impossible to predict if that will happen again. But great point, Will. From a pure economic standpoint, a recession just means that the economy, we judge that by gross domestic product, GDP, that has been negative for 2 quarters. So generally, we don't even know we're in a recession. We don't get the actual number saying you're in a recession until you've been in it for 6 months, for 2 quarters. And so we have a little bit of a scare because the first quarter this year, the GDP for the United States actually was negative. Now, the economists that we follow are not saying that that's actually due to consumer demand and everything that would normally cause a recession. It was more a byproduct of some internal things like trade deficit and things like that were squaring up on the balance sheet. So although we do have a negative quarter under the belt, the economists that we follow are kind of writing that off, saying that wasn't generally a recessionary type quarter.
Yeah, they're seeing it as kind of like an outlier experience that was more the byproduct of the accounting nature for which they formulated the details, not necessarily that there are systemic issues built into the economy yet. And I think that's supported by some of the other economic data we received through the first and second quarter. Is you had this one high, headline number of GDP loss, and then all these underlying details that were like, well, those don't coincide with negative GDP, right? The underlying fundamentals are different.
Mm-hmm. So let's talk a little bit about what we can look at from economic numbers that would point to an actual legit recession, which would make this bear market considerably more significant. So first and foremost, we all know recession generally coincides with high unemployment.
Yep.
And so we actually have a chart that will pull up that will show you that there's a certain peak in unemployment claims that has happened prior to or early in most recessions in the past. And so when we look at that current number right now, we just got the job numbers for April, and actually there's 1.7 jobs open for every one person looking right now. So in order for the unemployment indicator of recession to start triggering, we would need that to reverse. We would actually need job shortages, more people looking for work than there are jobs available. And we have the opposite of that problem right now. We have more job openings than there are people looking. So certainly that could reverse. We are hearing companies talk about hiring freezes at this point. So we could see that cool. But where we sit today, we do not have an unemployment problem that generally happens prior to or early in most recessions.
Yeah, I think that's really a key piece of information, because if we were to try and, at least in my opinion, if we were to try and label what's the most important factor for the U.S. economy, and if you look at how the U.S. economy is structured, the amount of it that's driven off of consumer demand, that's built off of a service style economy, the fundamental most important element, in my opinion, for that is the labor force, right? If people don't have jobs, they can't spend money, that can't keep turning the engine that drives the U.S. economy. And so if that's the most important piece, and that is strong. That means that the engine continues to turn, and it can fight through some of the other outlying pieces. You take the example of what's going on in Russia and Ukraine right now, the lockdowns that are going on in China. Those are big global issues, and you see places that have a more decentralized economy, or an economy that isn't driven in the same way that the US economy is. They're a lot more sensitive to some of those pieces. That's why energy prices are so much higher in Europe relative to what they are in the US. I think that our labor force insulates us a lot from some of those external pressures. Now, I agree with you that when you start to see the labor force pull back, when you start to see wages decrease, when you start to see jobless claims increase, when you see that ratio of jobs available start to compress to the number of people that are looking for it, that's when you start getting a pretty good indication that there's some fundamental changes that are going on in the US economy. And so that's probably the highlight piece of what I'm looking at to tell us, are we on the cusp of recession? Is a recession going to happen in the future? Recessions always happen. They're not an abnormal part of the US economy. But that's probably the biggest indicator. And from what I follow, a lot of people are looking at that. And we just haven't had it yet. We still have a really, really strong labor market.
But that's only one of many
Sure.
indicators that generally exist early or even exist prior to a recession happening. The other that we're watching very closely, we'll pull up another chart. Both of these recession indicator charts are from Blackstone Group. The other one is tracking corporate earnings. Generally, we see corporate earnings trend down and even go negative, again, prior to or early previous recessions. Now, in combination with unemployment. So you imagine corporate earnings go down, all of a sudden we're not hiring, then come layoffs, right? So we watch corporate earnings as a way to kind of see, is that coming down the pipeline? And we just got first quarter numbers. And so corporate earnings were actually very healthy year over year. And as you can see from the Blackstone chart, we're a ways away from turning negative on corporate earnings, and we'll express some of the concerns, geopolitical concerns, supply constraint concerns with shutdowns in China. Certainly inflation is something new for this cycle that we haven't seen in a long time. So there's a lot that could impact corporate earnings, but guess what? We've been dealing with all of that for 4 months now. And so far, it is not taking the earnings of the majority of the companies in the S&P 500 down to the area where we would be triggering a recession at this point.
Well, and I think that it's really important, and it's a good time to highlight for clients to understand that the reason we've seen some of the declines that exist in the market are not earnings. It's not companies are losing money. It's not even companies aren't continuing to grow their profits, because they are. So the stock market, the way that stocks are valued is a forward expectation. It takes traditionally current earnings and says, we'll multiply that by a certain factor, and this is what we think the stock's going to be valued over the course of time. When the COVID crisis started, and you saw an increase in demand, an increase in stimulus, a really robust level of consumer spending, we got into the point where a lot of these multiples stopped trading in the normal range of, the S&P's historically is kind of 15 to 20 times earnings is what they trade. They started reaching out. Some companies were trading at like 200 times their earnings. And so what you're seeing happen in the market today is not this thought, these are bad companies, this is an area of the market I don't want to be in. It's more of that compression is occurring across our earnings expectations. And the company saying, or people are saying, companies that trade for 200 times earnings aren't where I want my money. That's way too far out for us to be looking. And so there's been a pretty strong flight to quality. Quality in this context means high free cash flow, robust revenues, strong balance sheets so that you can weather economic contraction. And so I just think it's really important to highlight that the pullback in the market we've seen has not been fundamental changes to the companies. It's been fundamental changes to investors' expectations of the earnings multiple going forward. And those are two very different things.
I think that's a great point. Markets down don't mean unprofitable companies. It's just the market is trying to reprice things for the environment we're in today. And that's a normal, healthy thing in any cycle.
Yeah,
So,
the investor's appetite just changed. The investor's appetite for risk has just changed.
So let's talk a little bit about now that we know, hey, if we have a bear market without a recession, we know historically speaking, we've kind of gotten to the point where the market generally draws down. Could this time go deeper? Certainly our crystal ball works the same as yours, okay? But historically, if there's not a recession, this has been a time where the market generally kind of finds its footing, again, has repriced things enough to where it feels comfortable moving forward. If we do get a recession, then we will probably have a little more downside in front of us. So let's talk about what we can do. What can we do as individual investors to get prepared for that? And I'll kick it off with, first and foremost, if you have spending needs coming up, if we know a big ticket item is coming up, please give us a call. Let us start raising money responsibly in the account for that spending need that's coming up. Let's get ahead of spending needs right now if we can. If you're a client that has done Roth conversion strategies with us in the past, and that's something that your tax professional believes is the right thing for you at this time, doing Roth conversions while markets are down can make a lot of sense. So if you've done Roth conversions with us in the past, or your tax professional is saying, or if we've spoke with you about possibly doing them in the future, please give us a call. Let's talk about if that makes sense for you right now based on where markets are at. Will, can you speak a little bit from a portfolio standpoint, what we have done and what we believe we should be doing in this environment?
Yeah, my dad used to joke with me whenever I was frustrated or trying to fix something. He used to tell me that you don't build the ark while it's raining. You build the ark before it starts raining. And I think that's something that we've communicated, that we've been focused on doing going back to December. We expected volatility to rear its ugly head throughout the year. Certainly not to the degree that we've seen it so far. But by expecting that, we started making the transition inside of the portfolio to have more of that quality focus, right? High quality names, good brand loyalty, pricing power, high revenues. Those were some of the characteristics we were looking for the equity side of the portfolio. And we were focused on pulling away from some of the growth elements, right? I know it's scary when you see the S&P 500 nearly touching down 20%, but that doesn't take into the context that the NASDAQ, the technology side of the equation, is down 30%. And it's also going on at a time when cash, if you adjust it for inflation, is down 8%. And bonds, if you look at the intermediate bond market, they're down about 10%, right? So quality has been the thing that has been outperforming in all of these areas of the market. So it's high quality names, free cash flow. We started making those transitions back in December. We doubled down on it again this past April, increased the amount of exposure that we had to short-term or cash-related assets, increased the amount of exposure we had to investments that had less interest rate sensitivity, because it's a time of rising interest rates. And so by doing that, I feel like we've been working well and trying to construct an arc that can weather the storm. That doesn't mean we won't feel the ups and downs of the market, right? That's not saying that we won't experience some of the waves that exist, because we're not trying to be a group that makes huge tactical shifts in the portfolio and exposes us to more risk than we need to be, right? Our philosophy is taking unnecessary risk, making sure we don't take unnecessary risk. And so I think we've constructed that so far. It's interesting you mentioned the Roth conversion idea, because what I'm really looking at inside of the portfolio is not, does today make me need to think we need to change something for the portfolio because of the circumstances of today, right? The time to build the ark was before it started raining. I'm looking at it right now in the same way this Roth conversion idea is now a good time to be repositioning for what's to come. What's the future look like Do we need to make changes for the future? That Roth idea is a great idea, right? Do we get the growth in a different tax related vehicle? Inside of the portfolio, are we exposed to the areas that we feel are most appropriate for the current economic conditions? And I think we are. As we start to see economic conditions shift, that might change how we tilt our orientation. If we see things start to shift to where it's an improving dynamic, right? Market stabilizes, we see growth coming back into the equation, then we'll start looking at introducing that into the portfolio. But I think we've got a good ship to weather the storm so far.
Well, and as always, we use some of that extra cash cushion that we've built up throughout the year. I like to use the term, as things move from the sale rack to the clearance rack, there are certain things that become clearly something that makes sense longer term, and we're keeping an eye on that for you. But we wanted to take today to prepare you that in this type of market condition, as Will said, we want to, for lack of a better term, we want to make boring sexy again. We want to be with the companies that have those tried and true business models, the companies that have strong revenues, the companies that have that shelter built around them from a consumer standpoint. So those are the opportunities we're looking at right now.
Well, I think it's important to highlight, like you and I talk about this a lot. We always hear the phrase, this time is different, right? And there's a reality that the catalyst for pullbacks, corrections, bear markets, they can all come from different areas of the market. The catalyst for a recession, they're not always the same in every environment. But the human behavior around how we react to adverse investment conditions has been pretty consistent over the last 100 years. And I know we have clients, I've talked to clients about this, where they look back and they say, okay, dot-com crisis, 2001, man, that would have been a great time to buy this company, this company, and this company. 2008, man, it was scary, and I panicked and I sold, but it would have been a great time to buy this, or I wish I had just weathered the storm, right? And I want to highlight that while the catalyst for this market condition might be different, human behavior is not. So if you felt that way in 2008, you felt that way in the dot-com crisis, and you're able to look back now with the perspective of either that was a great buying opportunity or panic didn't serve me well. Panic didn't serve my financial plan or my long-term outlook on life. I think you've got to take that outlook and apply it to what we're going through today. Has panic ever historically served us well? Have these ever been systemic events that crushed the market and it never recovered? And do we bet against the U.S. economy? And it's been a bad bet over the last 100 years to bet against the resiliency of the U.S. economy. And so while the catalyst might be different this time, I think human behavior doesn't necessarily have to be.
I think we do need to acknowledge that although what you're saying, Will, is absolutely the right thing, and I think we can all look back in hindsight to different periods that we wish we had made different decisions had we known what we know today. The thing that can change, though, and again, specializing in retirement, we'll see people transition to a different phase of their life. So you may have been able to weather 2008 during your working years because, hey, I had time before I was retiring. Okay, I had working income. It wasn't a big deal. So now you're saying, hey, I'm on the other side of the situation now. Now I have my nest egg. I don't have working income. I don't feel like I have time to recover. And I'm taking income from the investment. I can't weather that again. And so the decision can be a bit different depending on where you are in the phase of your life. The answer is right, but the human aspect of being able to do it differs depending on the phase of life that you are in. We acknowledge that. That's why we lean on the financial plans. So if you're feeling that way, please give us a call. We can demonstrate with your plan through the stress tests of, are we going to be able to weather if this is a bear market with a recession and it goes deeper? Are we going to be okay? Is something going to change for you? We can very easily get you those answers. Okay. And hopefully we find out the answer is no. No, it's not going to meaningfully change your situation. And maybe that can give you the confidence to, make a decision that, that you want to at this point. But we thought it was important to show you the historical context that if we don't pair with a recession, other markets have found footing in the area that we're in right now. Again, no guarantee that that's what happens here, but it has happened recent in the past. And if we do pair it with a recession, how much farther down should we go? And then hopefully we presented some ideas of what we've done on your behalf in the portfolios, but also what you can be thinking of in terms of, do I have any upcoming spending? Should I be considering some tax strategies at this point, and talking with your tax professional and us about that? So that's really what we wanted to accomplish today.
Yeah, I think the last thing that I'll leave you with is I want clients to understand that the way we construct portfolios, and the way that they look at their assets, needs to be realizing that the portfolio's responsibility is to pay you for the rest of your life, right? So it's a 20, 30, 40, 50 year time horizon that these portfolios are constructed for. Inside of that bucket, the investments are invested in different ways so that they can meet expenses at different times throughout retirement. And while it can feel tough because all you ever do is see the whole bucket taking the ride, if you look at it from how much of this money do I need over the next 2 years, 3 years, whatever the time horizon is, and you drop down to realize that, well, that's only 10%, 15% of the portfolio, you can see that there are investments in there that are built not to take these huge fluctuations. So I might just encourage clients to either give us a call if you sat in with a meeting with me. I always talk about changing the perspective from zeros in the bank account to numbers of years of cash flow. And I'd love to have that conversation, because it is scary if you think this whole portfolio I'm going to need next year and it's taking the ride of the market. But if you look at it and think it's paying bills for the next 10, 15, 20 years, it can change a little bit in how we focus on it, because a lot of those dollars, they're not going to be used for a long time, and they don't even realize that we're going through a what feels like a pretty difficult time in the market.
And I love, if you're in that retirement phase of life, I love learning to see your money in the amount of years of spending that you have, as opposed to what my account balance is. It's a healthy way, I believe, to see things. So if you guys are feeling uneasy, you just want to talk over any of the information, we are here. Will even speak with you with COVID from home. So if you
I'll wear a mask. I'll wear a mask during the Zoom.
Yeah, extra safe. So if you need us, we're here. Hopefully today provided a little bit of context as to what a bear market is. Does this mean anything different for you? And so again, if you need us, please pick up the phone and call. Stay safe out there, and we'll hope to see you soon.
Take care.